You walk into a bank with $300 in your account. A teller smiles at you. She hands you a pamphlet about overdraft fees. That's it. That's the whole relationship. Now imagine walking into the same bank with $50 million. There is no line, there is no teller. There is a private room, a dedicated advisor, and a phone number that only you have. Same building, same logo on the door, completely different institution. But the real answer is far stranger than rich people get better service. Banks were never designed to serve you. They were designed to sort you. And the moment you understand the sorting system, you stop being confused about why banking feels so unfair. It isn't broken, it's working exactly as intended. Let's start at the bottom. At $0 or close to it, you are what the industry quietly calls an unprofitable customer. Your small balance doesn't generate enough interest income to matter, so the bank makes its money a different way. It charges you for the privilege of being poor. Overdraft fees, minimum balance fees, ATM fees, monthly maintenance fees that vanish only if you keep enough money in the account to not need the bank's help in the first place. Researcher Lisa Servon spent years working behind the counter at check cashing stores and payday lenders to understand why so many working Americans avoid traditional banks entirely. What she found was uncomfortable. Many low-income customers weren't financially illiterate. They were financially rational. They chose predictable flat fees at a check casher over the unpredictable compounding fees a bank could charge them for one bad week. Why would anyone choose a payday lender over a bank? Because a bank's fee structure can punish you for having no cushion. And if you have no cushion, you get punished constantly. This is the first truth. At the bottom of the wealth ladder, the banking system doesn't ignore you. It actively profits from your instability. Now move up. $10,000, $50,000. You're stable now. Fees start disappearing. You get a real debit card. Maybe a small starter credit line, boilerplate advice, an app that tells you to save more. You are no longer a liability, but you're not yet an asset either. You're what the industry calls mass market. Cheap to serve, easy to automate, replaceable. The bank doesn't need to know your name. A chatbot can handle you. At this tier, banks compete for your deposits, not for your trust. Your money sits in their vault earning them interest while paying you almost nothing back. This gap between what a bank earns lending your money out and what it pays you to keep it there is called the net interest margin. It is, quietly, one of the most consistent profit engines in modern capitalism. Push further. 200,000, 500,000. Now something shifts. You cross into a bank's label mass affluent. A human being calls you back. You get a financial advisor, though at this level the advice is often templated, a slightly personalized version of the same 3 portfolios everyone else at your tier receives. Economist Thomas Piketty, in his sweeping study of wealth across centuries, showed something that banks have known instinctively long before it became data. Returns on capital tend to outpace the growth of ordinary income over time, which means once you have enough capital to invest meaningfully, the system starts working with you instead of against you. Below that threshold, you're renting access to capital. Above it, you start owning a piece of it. That threshold is not an accident. Banks build entire tiers around it. At 1 million in investable assets, you officially enter private banking. Different building sometimes, different waiting room always. Your fees don't disappear, they transform. You stop paying small transactional fees and start paying a percentage of your total assets under management, which sounds worse until you realize what you get in exchange. Tax strategy, estate planning, access to investment products the mass market customer will never even hear about. Here's the counterintuitive twist most people never see coming. The wealthier you get, the less you pay for individual banking mistakes, and the more the bank tolerates your risk. Bounce a payment at $50,000 and you're flagged. Bounce a much larger payment at $10 million and someone calls to ask if everything's okay with your family, not your credit. At $10 million, you cross into what's often called high net worth private wealth management. Your advisor isn't managing a template anymore. They're managing you specifically, alongside a small handful of other clients, sometimes fewer than 50. You get invitations to invest in things regular retail investors legally cannot access: private equity funds, hedge funds, pre-IPO shares in companies still years from going public. The Securities and Exchange Commission actually restricts many of these opportunities to what it calls accredited investors, a legal status built almost entirely around how much money you already have. Read that twice. The law itself treats access to the best investment opportunities as a privilege earned by already being wealthy. At 50 million, you're not really a customer of a bank anymore. You're a client of what's called a family office, either your own private one or a multifamily office run alongside a handful of other ultra-wealthy families. Banking, insurance, tax law, philanthropy, even household staffing sometimes gets coordinated from a single office built around preserving and growing your specific fortune across generations. Economist and legal scholar Mirza Baradaran has argued that American banking was never built as a neutral utility. It was built, from its earliest days, around the idea that access to capital should track existing wealth and existing status. The unbanked poor and the untouchable ultra-rich aren't two separate stories. They're two ends of the same deliberately constructed spectrum. So why does this matter to you, specifically today, regardless of which tier you're currently sitting in? Because the tier system isn't just about how banks treat your money. It's about how it quietly reshapes how you treat yourself. At the bottom, financial stress becomes identity. You start believing you're bad with money, when really you're navigating a system engineered to fee you into failure. In the middle, you start chasing tier thresholds like achievements, forgetting that a private banker's smile is a service fee, not friendship. Near the top, wealth becomes less about comfort and more about permanent status maintenance, a treadmill with a much nicer view. The system doesn't need you to understand it. It only needs you to keep moving through it. But once you see the tiers for what they are, something changes. You stop asking why banks don't treat everyone the same, because now you know they were never supposed to. You start asking a better question instead. Which tier am I actually optimizing for? And is climbing it even the goal I want? You walked into a bank once with $300 and got a pamphlet about fees. Walk in again after understanding the system and you'll notice something different. It was never really about the money in your account. It was about which side of an invisible line that money placed you on.